Good morning, Rare ECN listeners. This is your Forex market commentary brought to you by Rare ECN. Today is Tuesday, 28th of January 2014. If you're trading the dollar-yen pair, we have an exciting week for you since this week is full of market-moving events. Volatilities are expected to run high, and risk aversion trade will be the prevailing theme for this week. I hope this commentary will provide you with insights to formulating your trading strategy. In line with today's discussion, we're going to look at the dollar-yen on the technical front. The dollar-yen cross began this week's trading session lower, mirroring last week's drop in the S&P 500 on risk aversion trade as investors are piling on to safe haven fearing risks on two fronts. Possible emerging market crisis in this week's FOMC meeting as well as Japanese CPI releases. On the Forex option market, the price of these options employed by investors to hedge against headwind market risk indicate that the expectation for volatility in this coming week is significantly high. This also implies a possible major dollar-yen breakout either to the upside or downside is largely depending on how the risk event this week will unfold. The analysis of a collection of technical indicators on the 5 hours interval on the dollar-yen market suggests a temporary bearish market sentiment and recommends short positions on the greenback. The 5-hour chart established short-term Fibonacci resistance at 103.12 and Fibonacci support at 101.92. In accordance to those short-term moving averages, the dollar-yen opened today's Sydney trading session below the 5, 10, 20, and 30 days simple moving averages, indicative of a bearish market sentiment building into the pair's trading outlook on the technical front. However, despite Monday dollar-yen retreating on disappointing U.S. home sale number reading of 414K, missing expectation of 457K reading, the pair continued to trade above the 200 days moving averages, indicative of long-term U.S. dollar Japanese yen outlook remain bullish. This trend holds great significance as 200 days simple moving averages contain more or less of 1 year worth of trading data. Now let's closely analyze the 5 hours time interval indicators. First of all, we have the RSI, which is the momentum oscillator. Its price value right now is sitting really low at 35.854 with a strong recommendation of a sell. Moving down 2 notches, we have MACD, which is the moving average conversion divergent. It has a price value of minus 0.32. It measures the 12-day EMA is sitting below the 26-day EMA with technical recommendation of a sell. Moving down 1 notches, we have the ADX, which is the average directional index. If a reading is above 25, it shows that the trend is picking up really strong. It now has a price value of 33.272 with a strong sell recommendation. Moving down 2 notches, we have the CCI, which is the commodity channel index. It confirms a buy or sell signal. It now has a price value of minus 50.544 with technical recommendation of a sell. So lastly, we're going to look at the bull to bear power ratio. The bear is having the upper hand right now with technical recommendation of a sell and the price value of minus 0.5830. Overall, we have 2 buys, 8 sells, 0 neutral, and a total technical consensus of a sell. Now, moving on to the fundamental front on the dollar-yen market. Emerging market is very much a part of the fabric of risk investment in the broader Forex story. The reason underlying this is the emerging market represents high-yielding investment against the backdrop of 30-year low of the bond cycle that the U.S. Treasury have been stuck in. Since the financial crisis of 2008, emerging market ETF investment has shown strong advancement but eventually plateaued in growth since 2011 as capital investment into the S&P 500 continued to pick up. The prevailing recent headline news is currently reporting on problem arising from Argentina to South Africa and Turkey. This begs the question, can this escalation provoke a full-scale risk aversion by which the dollar-yen market are highly sensitive to? The large proportion of emerging market capital investment is largely funded by either the yen or dollar carry trade. In the case of a full-scale risk aversion where margin calls and market fear can often force investors to unwind their position quickly, by which the yen can be a major beneficiary. This unwinding in risk trade is more profound in the Aussie dollar yen cross or the euro yen cross. Fed's tapering action play a great importance in the dollar yen market with respect to the correlation that the peers has with the S&P 500. Last week, 2.6% drop in the S&P 500 on Friday was also mirrored by a sell-off in the dollar yen market too. The S&P 500 advancement over the past year was structurally supported by the Federal Reserve QE program and the future expectation of capital investment into riskier asset funding rate. The funding market, particularly the yield curve on the 1 to 3 month US Treasury, provide great indication to investor sentiment and market consensus on rising crisis. So this week is full of risk events that are inducing of volatility on the dollar yen front. On Tuesday, the market expected a reading of 1.8% in US durable good orders, followed by a CB US consumer confidence reading of 78.1. Wednesday is the FOMC meeting where the Federal Reserve Open Market Committee will vote on tapering its QE program, with market consensus expecting the Fed to taper by another $10 billion a month and expecting benchmark rate to remain low at 0.25%. What the market is also anticipating is how the Fed will digest the recent mixed economic data and the language it will use to signal to the market its future action towards monetary policy. Thursday release also include US GDP number quarter on quarter expected to come out at 3.2%. Traders who are sitting on the dollar yen position are also concerned about Thursday's release of Japanese core CPI number year on year, expecting a reading of 1.2%, along with household spending expected to tick higher at 1.2%. The market has also recently become fearful of the Bank of Japan might not follow through with its open-ended program. This CPI data will validate this view. If the market gets a consistency in CPI reading advancing towards the Bank of Japan target CPI rate of 2%, then speculation of an end to this open-ended program may materialize.